All right. Hey, everyone. I'm back today with a conversation with Ed Coburn. And a lot of you know Ed. For those few of you who don't, Ed has been, he's the owner of Cabot Wealth. You recently purchased it. But you've been with Cabot and in the industry for, I don't know how long, Ed.
Well, depends on what part of the industry, but I've been with Cabot for 5 years,
Mhm.
and I've been around parts of the industry for about 35 years. So,
Awesome, which is part of why I wanted to have this conversation, because there are fewer and fewer people who were around in 2008, let alone 2001, who can speak to kind of the change in the market that we've had over the last 2 years.
yeah, it's interesting. I had lunch not too long ago with a a good acquaintance, but industry acquaintance of mine, but he's a younger guy. He's 30, and he was telling me I got to know him because he grew up in the area, but he also turned out to have been a classmate of my son's in college. And so we were talking, and he said, "Well, last year was I got as good an education as I got in college." And I asked him, did it cost you more than the college? And he said, "No, it cost about the same, though." And he was talking about all these things that he'd been able to get away with, jumping in on any dip and buying it. And he said, "I got burned so many times jumping in on dips that just, continued to fall down and those kinds of things." One advantage of being old is we've stubbed our toes on those things a lot more times than this guy had.
Yeah,
So
yeah. I think that's I think our industry, for very many obvious reasons, we parallel what happens in the market.
right.
And that experience that you're describing him telling you about is exactly kind of what I feel like a lot of people are going through right now. And they're attributing it, and I would say misattributing it, to the correlation with the FTC stuff that came in. Not to completely dismiss and say that the FTC kind of changes in the copy side doesn't have an impact, but these are two separate things that are happening.
Absolutely. Yeah, absolutely. We've always we've been hit in our 50 plus years. We were founded by a guy who was an investor and an engineer by training. We've always been very product oriented. I would say when I started looking at the company, the son of the founder, who was the owner at the time, said, "I'm probably our biggest weakness right now because I'm not a marketing person, and that's what the industry is driven on." And that's so we've always been a little bit under marketed. But even so, we're making adjustments because of the FTC, and I really appreciate the program you did, bringing that to our attention and that sort of thing. But I don't believe this has anything to do with what the FTC is doing. This is the cyclical nature of our business, and like the stock market, it generally over the long run is up.
Mm-hmm.
But it doesn't mean it's a straight line. It bounces around, and this is a bounce and a bigger bounce than some, and not as big as 2008, for instance. So
Right. Yeah, and I think that's where, so like I have a couple of frames that I look at for the market, and like I would say that I just kind of had this back and forth in a YouTube conversation. It was a good one, but I was kind of pointing out that a comment kind of thread with some people or somebody, that I'm not bearish on finpub until about 2045 to 2050. And the reason for that is that, so we know that the boomer generation is still going. They're still increasing brokerage accounts, by the way, year over year. But they have a legitimate replacement generation in the millennials. And so that means that the total audience size, potential audience size for investing fundamentally doesn't drop significantly as millennials go all the way through the life cycle of investing, which starts aggressively we're not even there yet. Like 45 to 50 is when you start getting into that, and they're not even there yet. And then you add on top of that, that on a percentage basis, the millennial generation is much, much, much more active than the previous generation in terms of being self-directed. And what you have is the same total population with a higher participation rate. So I'm fundamentally bullish just from the demographic factor right now. Now, yes, you could talk about the financial issues that millennials have compared to the boomers, but I don't think that speaks to the fact that like the basic customer universe isn't going to disappear. And there's a whole lot of nuance in there that you could get into. But if you're just looking at it from a big picture, it's not until Gen Z hits their retirement years that I would be bearish on like the audience size.
Yeah. And I agree with you 100%, John. And, you know, as far as what's going to happen with Gen Z, when I started in my career, we used to do like 5 and 10 year forecasts. Long range forecasting for me now hits 3 years. You know, well, who the hell knows what's going to happen? What things are going to be like with Gen Z? So you know, that's far enough away. We can worry about that later. I do need to be worried about the next 3 to 5 years, and I see nothing but growth. You know, the number of people that are in investing, self-directed investors, continues to grow. Everything, and you know, one of the things I love about our industry is, even though obviously there's some very big players in it, they're big players because they own a lot of small brands. There's not a Google play here or an Apple play to come in and say, we're going to be the definitive voice of here's what to invest in. That doesn't work in our industry. That if they tried to do that, it creates all kinds of opportunities for people to invest around them. And there are strategies that, you know, I could come up with off the top of my head to make a play if Google were to be saying, buy this to everybody. So, you know, I'm really bullish on our industry in a, you know, any reasonable time frame that I'd want to be forecasting. So
yeah, exactly. So I think that's a great point. Like that's actually, I hadn't thought of that frame actually, that you're right. Like this is not, I mean, an industry that can be aggregated into a single kind of like investment information can't be aggregated into a single giant tech play.
Right. Now, Bill Bonner, that's not to say Bill Bonner couldn't buy us all out tomorrow and we'd all technically be part of Agora, but there couldn't be one brand that you know, you'd still need the fundamental sort of a configuration of the industry, having a lot of little analysts and experts, you know, giving their thoughts and ideas. I don't see that you can really get away from that. So yeah, that's somewhat reassuring in these days, as you know, so many industries are getting totally disrupted by some huge player coming into the market and crushing everybody.
Yeah, no, that is, and I do think like people like when people start adopting that sky is falling down attitude, they kind of forget that financial markets are the premier information marketing publishing sector of all for some very specific reasons. And I would say like one of them is the fact that, well, the information need, like information is alpha, always has been, always will be. There's so much complex information in an increasing amount. You need that information to make decisions. And you're talking about like protecting money you made or making more money that you made. And so because of that, like there's a constant and ongoing need for complex analysis, editorial recommendations, and it supports a huge audience that has the wherewithal and the reason to spend higher price points and to do it across multiple products. And there's very few industries like that anywhere for information.
That absolutely, yeah. I mean, people, you know, I can't even frankly get my head into where they're at, thinking that this is anything more than you know, a periodic dip and correction. It's so clear to me that we're in a very resilient industry. You know, as you say, people will always have money. They will always want to find a way to protect it at a minimum and grow it ideally. Mm-hmm. And they're always going to be looking for an edge. So I just don't see. I have not a moment's hesitation about the viability of our industry, and that I do understand. I think you posed this a while ago about are the golden days of our industry behind us. Maybe, I mean, a little bit the Wild West of days of our industry are behind us. You can't go out and do the kind of shooting from the hip, frankly, BS that made the industry what it was in many cases.
Yeah, and actually, and I posted that, and the reason I posted it, that frame was more to kind of like outline like the different tailwinds that we've had as an industry. And it's not that, and like the first one, which is demographic, isn't really going away. And the second one with media and advertising, it's not that that's going away. It's that I think that we had a hiccup, a temporary change over that. We're in the late stage advertising model, which we've never had in the internet history because it's not that old.
Right.
And so the real potential right now that I'm really excited about just how this is going to develop is, well, how is AI going to disrupt the Google and Facebook and other advertising ecosystems? Because that's going to create a whole new kind of acquisition or advertising media regime for us.
Yes. Right.
And then we'll go through some of those same cycles again.
Right. And we will figure out how to surf that wave as we figured out how to surf email and SMS and direct mail before that, and social media. And it's another tool that we're going to have to get familiar with. And first we're going to need to let the tool mature and stabilize. But yeah, I don't see that in any way a threat to our industry. It's just another thing we have to learn.
Yeah, exactly. And so it's almost like I think what it is the people that I hear crowing about the end of FinPub tend to be like, they tend to be almost invariably copywriters whose commissions are not coming in. Two, they are not copywriters who've probably had the highest levels of success. Three, even the ones that are higher success were ones that were operating in one of the businesses that were using some of the more aggressive copy that the FTC did have kind of a more of an impact on. If every promo is tied around a 10,000% return, and that was all of your success, then yeah, you don't. Right. It's like you don't even have a frame of reference for how to write a promo that isn't that.
Right, party's over there, guys. Yeah.
Right, and I think that to kind of get into it then is that when I go back to the types of promos that happened post 2008 and going back into my swipe files and stuff that I got from Clayton Makepeace to the kind of post tech wreck, there was a lot of stuff that worked and a lot of stuff that worked really well. And so how do you, having been through these market cycles, like how do you think of this particular market cycle in specifically in relation to previous cycles right now?
We hear the phrase around our office a lot. History doesn't repeat itself, but it rhymes. Mm-hmm. So things always are slightly different. There are different conditions, but there's an awful lot that's the same. And there's the pandemic, and then inflation, and all of those things just instilled a lot of uncertainty. There was the whole world kind of paused and took a breath and was like looking around like, well, okay, what's going on? And, and then, I mean, this disruption of the supply chain coupled with inflation and particularly gas prices, because we overreact to gas prices as an economic indicator. But that shook consumer confidence, and every time we start to get it back, we get, a January jobs report that was too hot and raised inflation fears, or we get, SVB failing. So, I feel like we're going along, but it's really tentative. And every time we start to, do this, it takes just one thing to kind of knock us back down. But it will change. And it's very much my expectation by the end of this calendar year that things will be significantly better. And going into 2024, to me, this is just it's another thing. I'd love it if it didn't happen. Boy, 2021 and 2020 were awesome years. But this again, for someone that this is how I've made my career, creating publications like this, marketing them effectively, that sort of thing. And, easy years are fun because they're rewarding, but they're frankly not that intellectually challenging. So, this is just making us have to work a little more.
Yeah. And just there's like a bunch of thoughts that pop up from what you just said. And the first one is you use that, it's great, the issue of uncertainty. And I think it's like the first thing that anybody has to realize right now is that the primary emotion of the market is just that, is I don't know. And that makes me uncomfortable. And so when I think about like in 2008, so 2009, so you think about what happened, right? You had this massive crash that started in October, and it was just blood in the streets. You had Lehman, all this stuff started happening. I mean, it was horrific. And then in March, which is at the bottom, it's literally like, I think March 3rd to 9th, somewhere in there was the actual bottom. Makepeace had a promo that did $15 million. And the essence of it was the $1 million contrarian portfolio. And so what Martin did was it was for Martin Weiss, and they put $1 million in an account to show how confident they were, right, in what they were doing. But it was basically a long short strategy, right? And so the messaging was, I think this is going to happen. Here's all the reasons why. But if I'm wrong, we still can go up. And so it was addressing that uncertainty. And actually, I was having this conversation with a couple other coppers the other day from back in the time. And there was a period where a lot of long short promos worked. And it was the long short strategy, which was specifically addressing that issue of uncertainty. And I had a promo. I mean, my biggest promo was back during that period of time. And and it was, looking back, I was like, oh, wait, we were doing a long short strategy. And I think about like the other things that came back at that time. It was all things that worked from the question of dealing with uncertainty. Real money traders were coming out and showing real trading returns. Like Tim Sykes was publishing his brokerage statements, and there was a bunch of other guys like that kind of popped out. And it's like, oh, it's all about confidence and certainty. Like, do you know what you're doing? I don't know. Everyone's scared, and so like you're really just selling confidence right now in what you're doing.
Yeah, that's right. And one of the things we related to that's a little tougher is, but talking about, if you wait until you are reading that the market is hot again to get back in, you've missed a whole lot of upside. So, and chances are you're not going to be able to, confidently get back in at a good time. So that's a lot of the messaging we're giving to people now is, this is the time, the Warren Buffett getting greedy when everybody's fearful, and fearful when everybody's greedy. Everybody's fearful now, and you should be thinking about being greedy, but don't be stupid about it. So, I mean, my grandfather used to run retirement funds, including for GM, back during the Great Depression, or in that time frame. And he once showed me, as he plotted it on graph paper by hand, but he plotted all the investments that he made in as an adult from the time he was 20, 21 through whatever, and he was showing the investments that he made at the beginning of the Depression, and how long those took. And he was very much a buy and hold guy, and he would buy these stocks and ride them down, and how many years it took to get back to whole. The investing is much more sophisticated now than it was in that day. We certainly would tell people, don't buy and hold it, dump it, buy it back when it comes back around at the right time. And that's where we can help you about when to buy it, and you're not tying up your funds and that sort of thing. But so to me, it is just another opportunity. The challenge is that talking to many of our analysts, we use the term analyst rather than guru or anything else. But it's towards the end of last year, they were kind of saying, "Oh, well, the market seems to be coming back, so that's great." From an investing standpoint, things can come back. From running our business standpoint, we don't just need the stock market to come back. We need consumer confidence to come back, and that's what drives selling subscriptions. We can hold on to our existing customers, but bringing in new ones is really dependent on that. And so, selling confidence and really selling self-confidence is a huge part of the positioning right now.
Right. And I think that's why education tends to sell a little bit better during these times. So people realize I need to understand this better. There have been a few I have heard from a couple of larger publishers that they've had some trading system promos work really well. We've seen on the front end resource stuff working really well. But the problem there is that a lot of publishers have over the last several years have cut their entire resource expertise out because it wasn't in cycle and for so long. And now that it's actually in cycle, they tend not to have expertise and staff and therefore product to sell, which is a difficult thing to navigate right now. But I think that's part of this whole kind of rejiggering of our ideas right now.
And one interesting thing about I tend to think about our industry as an industry, but there are really different ways to play our industry. And and I think this is something you made a really excellent point. I thought you made again in January at your event, that for some of the big players in our industry, going the sort of cyclical nature and staffing up heavily in good years, and then having to staff down and lay people off in bad years, that is part of the business plan, the business model for these companies. I'm not in that category. We're much more of a traditional publishing business, and so so it means we didn't squeeze as much juice out of the hot market, but we also didn't have to adjust or lay people off, in the down market. And we do have, that education, that research piece stays with us. But there are just different approaches. I don't think one is right or wrong. If you're trying to make, if your focus is big, maximizing the big bucks, unquestionably the other model is a better model for that. It's just it's a little more hair raising and nervous making. So
yeah, it is, and it's one of those things where I looked at MarketWise is I track their all their earnings calls and everything. And you see during the boom, they added a ton of products. I forget how many, but they got up 190 or more or whatever. And then they had a big cutback on products. And it's okay, well, someone from outside the industry would think, oh man, they had this huge thing that's a problem. And it's no, it's that was actually a sign of an efficient operator, because when it's booming, you make money by adding product and promo.
Right. Yeah.
And then when they have to cut back, and of course that staffs up because you have a lot more production. And then when the market pulls back, they got to start cutting product. And then all the people who were basically providing that product doesn't have a job. it's unfortunate, but it's like it is the cycle of that larger scaled business. But like, to your point, like everybody that I know who has had a stable, strong business before the pandemic boom happened, are actually up relative to the numbers that they had pre-COVID boom.
Oh yeah, absolutely.
Right?
Yep.
And so I started tracking this. Like, so if I look at like, and I like using MarketWise as a proxy these days for the industry, because they are so many brands and but if you look at their paid subscribers, right? Like from like, even like the growth in 2020 on their paid subs, they went up like 65, 66%, but they're only down about 16% in total subscribers. Now their revenues are way down, right? Because the back end. But I think a lot of that has to do, but the customers didn't churn out. They're just not buying additional stuff right now because of uncertainty.
Right. Because they're not making as much on their portfolio, and
but they're not gone.
Yep.
And I think that's a really critical thing. And then the other thing that I think that like people outside or new to the industry don't get is that when things are bad, our actual audience tends to actually be growing. So like free lists, because people are paying attention because now they're freaked out. And so like you see that again using MarketWise, like even with the revenue down, their free subscriber base has grown dramatically over the last 2 years. So like the attention is there. So when things pick back up.
Exactly. Yep. Absolutely. And they're positioned. There's like, oh, these guys have been saying really smart things. And now that, the market seems to be doing better, my rate of statement from my 401k is actually positive, and maybe it's time for me to get back in, and I'm going to take them up on one of their offers or whatever. Absolutely. Yep.
Yeah. So I think that's where it's almost like, and I wonder, and this is total theory, no real evidence of this, but I wonder if the customers who come in the bad times, who come in slowly and cautiously, they're coming in because of the fact that like, wait, I don't know this as well as I thought. They're probably coming in from a fear of loss, which means they have money, which means they're a fundamentally better customer than the people who come in during like the crypto peak.
Right. Yeah. I think that's right. I mean, I've never seen any data, but I totally am with you on that. Particularly it's not that you have to come in bad times to be a good customer, but certainly the people that come in, in the last 10% before the peak, they're going to fly right back out as soon as things cool off. They're obviously not terribly sophisticated, and they're much more followers. They're very slow to act, and they're going to get scared right back out. So yeah, it's hard for me to imagine that you're not right on that, John.
Yeah. So I think that's just like, it's interesting, and so it's kind of, and I see that in our business too, just from the business side, like. All the people who kind of rushed in and were like, oh, it's so easy to make money in FinPub are kind of like, this isn't so easy. And they're not really around, but like the diehards, the people who are like, no, this is the greatest, like who understand it, who this is the greatest business in the world. Like, okay, we're still here, still succeeding, still making money, and still going.
I mean, with all due respect, I mean, the Financial Marketing Summit in, 2 years ago was awesome, but again, not to say any idiot could be making money in that market, but a lot of idiots.
But a lot of idiots did.
and so, but what distinguishes the serious people is, what happens when things get tough? Are you in this? Are you gonna do what's necessary? And particularly, as you talked about earlier, it's not just that we had the market drop off. We also had the FTC coming in. I mean, it's like these things are happening and you're going to step out for a moment? Really? That just seems like the worst possible time. I remember learning in business school, learning about how and maybe someone on one of your podcasts even mentioned this, but how Post cereal was the leader in breakfast cereals in the U.S. until the Depression, and they pulled in their wings and said, we're going to just ride this out. And Kellogg's kept marketing, and totally stole market share. And these days, if you ask a kid about what cereals are, the Kellogg's the only brand they even know. I mean, they totally dominated, and it was because they stayed in the game. And I mean, I think that's such an instructive lesson. So, and hopefully a pitch for your events as well.
Thanks. No, that's I think that is the thing, is the because I remember this after 2008, and it was my friend Charles Mizrahi and his brother Gary had they were basically selling advertising, and they had a kind of a newsletter that Charles wrote. And I remember they went from, it was back when Google pay-per-click was like the most profitable thing in the world. Like you could basically like buy the click and sell the lead, the co-reg on the back, and be profitable just on that transaction.
Yeah, immediately. Yeah.
Amazing. And I remember after 2008, like talking to Charles, and it was like everybody was stopping their spend. And he's like, we're just like, wait, our numbers, it's like our math is not, it's different, but like the leads are cheaper. And what happens in 6 months when things pick up again, everybody who doesn't have like traffic isn't going to be able to sell advertising. And sure enough, they kept going. And when things kind of turned, they had a very robust business already in terms of advertising spend or revenue. And like the people there was a lot of lead sellers at that point who weren't in the industry anymore, and they were out pretty quick. Right.
Now, it's a fine line between bold and stupid in markets like this. I mean, the return on your marketing dollars have not been close to the same. And so, I can't, we certainly haven't continued to spend at the same level we were spending in 2021. It's just off. We can't find opportunities to spend it and get the kind of return, but we very much have made an effort to stay present, keep in there. And, we'll accept, sort of returns. We'll accept lower returns right now than we would have 2 years ago, because we do want to keep positioned so that if and when things pick up, I started to say when things pick up, I want to have traffic, I want to have lead flow, I want to have all of that so that we have something to act on.
Right. Yeah. Yeah. And that's just investing in the fact that the business is going to continue.
Yeah. And going back, you mentioned earlier that, some of the doom and gloom seems to come from the copywriters. I do think there's something to that. And I think there's another factor for them, which is that the model of paying royalties based on whether it's number cent or whatever, that the industry I think is shifting more towards a fee for service model and moving away from those royalties. There's supply and demand. And there are a lot more copywriters out there, and now there aren't a lot more great copywriters, but a lot of the industry doesn't run on great copywriters. It runs on pretty good copywriters.
Right. And I think, go ahead.
And I just think the power dynamic there, and I've seen this in other industries, where the old modes don't work anymore. And so, I think I suspect that's part of it too for the copywriters. Mm-hmm. Is they're seeing their business model changing a little bit, and not in the way they might ideally like. But
yeah. And I think so, like Porter had a point about that, where he was talking about the difference in compensating writers based on the promo versus the business. And it's like he wants people who are invested in the success of the entire business rather than an individual promo.
Right.
Because one, they stick as staff, and they can make a lot of money, but they have to then, like, you can't just do a promo that churns really bad on the customer because it's not what the customer really wanted or was getting.
Right. Yeah. Yeah.
And so like you have to be more aligned with the business itself. But then also like back around 2000, after the 2008, like, I think of these in terms of big business cycles. There was a shift and a movement away from a huge freelance population approach to copy to that in-house, more dedicated on retainer writer. Because they could get to know the business better. They can get to know the ideas better. They can get to know. And then I think like in the last, again, like late stage bull market kind of stuff, you had a return of more and more freelancers because the money was good. It was getting right. It was easy.
Right.
And a lot of those are the ones who are, you can't just like if your copy approach is just big money fast, you're not really in a position to do well in this market.
Right. That's right. Yeah. It's harder. And then of course the FTC stuff on top of that just makes it harder still. So yeah, anyway. So yeah, I mean, you certainly were signaling that using the copywriters as the sole, yardstick was probably, not perfect, the perfect measure of the health of our industry. But
yes. Yeah. I say this, and I love copywriter. I
yes, absolutely.
Copywriter. Most of my friends in the business, I have so many great copywriter friends in the business, and we always make fun of copywriters as a group together because we know like you're copywriters, you're a bit histrionic as a person.
Right.
It's part of what makes it great.
Right. That's exactly. It's a self-selection thing. That's a required part of it. Yeah. So
I remember when I was working in the office with Clayton Makepeace, it was like you could tell how well a promo did by how he came. I remember him doing that like huge promo in like when he'd like dance into the office on a cloud. Right. And then if he had a promo that didn't come in well, he might not show up for 3 days. And when he did come in, it was like under a thundercloud and he's all depressed and the world is ending. And it's like, it's part of his genius. It's like the ability to put emotion into stuff and to feel like, so,
it is, it's very much, it's the artistic end of our business. Yeah. And you got an artist temperaments that's involved there.
But to like the point of copy, it doesn't mean, this is the thing, is like, just because 10,000% returns are not something you can say anymore doesn't mean that there aren't phenomenal copy approaches that have worked for so long.
Right.
And I had this conversation with Dylan Jovanet on here. And then I had it last week with Addison Wiggin too, just privately. This is a newsletter writer's market in my mind, because it's not just big gains. There's so much happening in the economy, in the world. There's so many stories to tell right now that are just like massively impactful and fascinating.
Yeah. Yeah. No, I think that's right. And, whether on the marketing or on the product, late stages of a bull market are, you can say almost anything. I mean, the last year and so far this year, if you want to keep readers engaged, you can't just keep throwing hot stock ideas at them because there aren't enough. So, you've got to up your game. You've got to give them education and insights and interesting stories, things to keep people engaged. We absolutely see that in a market like last year, we have a harder time bringing in new people, and we will also see some hit, particularly on the people that came in late bull market. Again, we'll kind of flit off. But the good customers stick around, and they're the ones that are the most bonded to our analysts and believe in their worldview and their investing strategy and philosophy and that sort of thing. And this is a time when you can really strengthen those bonds. So, and I think about, in the wake of 2008, I remember having several years ago a conversation with woman who subscribed to one of our publications, and we moved her to about 70% cash in early during through the summer of 2008, and then we got back in buying in early 2009. Wow. And she said, the flip between them and the market, she said she was a lifetime subscriber for us, because she was up like 47% in 2008, and then she was up like 80% in 2009 because of that. And so these are the times where you can form that kind of relationship. And she used to just tell everybody this story, which was awesome for us. But
yeah, and that's where that is a great point, because it's almost like you're doing all your other front end marketing to find those people who are going to, one, stick with you the longest, and then two, buy the most back end products, right? The ones who are going to really be in. And it is the people that you prove, who's in the foxhole when things are bad. Really helped. And no, that's cool. What else do you think about, in terms of stories in the market, or what kind of ideas are you looking at these days?
Well, certainly we had launched, over about a 4-year period, we doubled our business, and we also doubled the number of products. But the ones that we launched in late 2021 and early 2022, we did decide. I knew we were launching those. Some of those I certainly knew we were launching into a headwind, and I stuck with them for a while. And then late last summer, I pulled the plug on them. I just realized it's one thing holding on to an existing product, but trying to create a product, we just weren't being able to get enough traction to have it be worth it. So those were the first products I had killed in a little while. So we killed I forget, 3 or 4, and then since then I've really been focused on our existing products and shoring them up, and being opportunistic. Part of it also was just we had so many products we were marketing that we were spread thin on a resource from a resource perspective, and so we did that. So we've got some new product ideas that we had sort of kicking around that we've just kind of put on ice. And I think I'm totally confident we will be launching new products within the next 6 to 18 months, but I don't know exactly during that time. And we're going to want to see, the market being clearly solid. If we keep sort of bouncing along as we are right now, it's going to make me wary. It's going to make me want to put the resources into our existing products and not so much launching new ones, right? Where there's just more risk. But right now we've pretty much covered. We pretty much cover the waterfront. I think sort of psychographically as a company, we're bullish. We believe in the long term up of the market, right. And that's very much our orientation. But we certainly have products now that do well in any. Some of our products are doing well in any market condition. Right now, I suppose if the wheels fully came off for an extended period of time, I might have to rethink that statement. But so I feel reasonably covered. Although as we saw, we had one product that did very well last year, but it didn't really matter. We frankly doesn't. This is I think really important to keep in mind. It doesn't. It may not matter that the investments are doing well if you can't get customers to pay attention, we still it did very well, and we've been steadily growing the subscribers to that, but it's still, given how well it's been doing, it should be growing much faster than it has been, and and that's just the market. So we're in a little bit of a holding pattern, but we also took advantage of the opportunity last year to totally replace our technology platform and update it to current technology. We were on about 8-year-old technology, and things had changed a lot during that time, and that's a big project. And frankly, the opportunity cost to do it last year was much lower.
Absolutely.
So because it invariably takes a lot of marketing resource time and product resource time and all of that. So I think that's also been part of what we're doing is, while we're kind of in this holding pattern, is shoring up our system so that when things start to pick back up, we can be that much more aggressive and that much more productive.
Yeah, no, that makes a lot of sense. And I think that that's actually a really good point, that when things are slower, your opportunity cost is lower to do things that maybe you wouldn't take the time to do otherwise.
Yeah, I mean, it's really, I'm not a huge racing car driver fan, but we were under a yellow flag last year, and everybody pulls into the pit stops under yellow flag and changes their tires and oil and all of that kind of stuff. So so I feel good about that. I feel like we've done the things we can do, and we're continuing to probe things, and we're doing some new things with Tim over at After Offers, and
Awesome.
so we're testing more things so that, again, so we're ready. We're not making big plays, but we're doing little stuff so that we're ready when we need to. We can just start to turn up the volume a little.
Yeah, that makes sense. That makes a lot of sense. I think like I said before, I think that the bull markets are longer than bear markets, and it's not even a bear market that's fundamentally bad for the industry. It's more of wait, what are we in? It's like,
right.
It's not fear. Right. It's not greed. It's like, I don't know if I should be scared or greedy. So I'm just going to kind of sit here. And so, I don't think that that's going to last. Like, uncertainty is not going to last for too long. And I feel like with an election coming up next year, that's giving me more confidence, because it's rare that you see things totally, unless there's some external, massive external development, there's usually a lot of pressure to make sure that things are reasonably solid. That doesn't mean they're going to be, massive bull run next year, but I think there's going to be, people that are doom and gloom. I just don't see that happening. It seems like, it's remarkable to me. I was having a conversation with one of our growth analysts, and this was about 3 weeks after Silicon Valley failed. And he was commenting about how, if you had told me we'd be having this conversation 3 weeks later on the day that we were learning about SVB, I would have said, no way. But things get incorporated and baked in so remarkably fast these days that it takes a fair amount to really knock the market off its axis, and so I think I just see that's going to continue to go forward. I agree, and I think like that. When I do think about because I can't help myself. I think about what would you do if something major really did happen? I mean, like China goes in and we go, all of a sudden we're trying, what does the industry do in kind of global chaos, everything changes that has impacts on everything. And it almost, to me, it feels like you almost kind of double down on the extreme nature of your best customer base. And so like, on the active trading side, there's going to be like a lot of fast trading. People are going to crush it in the volatility that would create. And so you would be really focusing down there. And then on the investing side, the upper end of your customer base, the people with more money are going to be willing to spend more money to like have like, you know, like think of like Stansberry's Atlas Club or whatever has gone up in price every year since it started, or every, you know, it went from 10,000 to 35 or whatever thousand it is now. And like that upper part of the investment base who has like a large thing to protect, like they're going to be more engaged, more willing to spend money, maybe come in person to like really start to understand what to do. And like, it's kind of like more hands-on, which means it just changes kind of your product mix. Again, it doesn't go away.
Right. No, I think that's right. And, you know, and if China or Russia starts lobbing nukes at us and vice versa, you know, at that point, I don't frankly need to scenario plan for that. Yeah. We're going to all be making that up as we go along.
Yeah, exactly.
But I totally think you're right, and you're going to make me go and do the math on this. But I'm going to ballpark estimate that the top 20% of our customers generate 60 to maybe 2/3 of our revenue. Comes from the top 20%. So you can, you know, if we had a strategy, I mean, you know, if the shit was really hitting the fan and we had to sort of say, let's collapse down, we can collapse down to a pretty small base and take a much substantially less proportionate hit to our revenues, and really simplify things and up the personalized kind of, you know, hand-holding kind of stuff. So that, you're going to make me go and look at those percentages to see what they actually are. But that's my guess. I'll confirm next time I see you.
No, I appreciate that. Yeah, no, I love. For me, it's just more of a. I don't have to have a solution. I'm always thinking about like, well, I don't want to spend a lot of energy on something that's that theoretical, but I want to think about it enough that if something did happen, I have a direction to think. And then I'm like, okay, then we'll wait and see.
Yeah, no, I completely agree. I always think of the two quotes about, you know, failing to plan is planning to fail. And then I forget the exact wording on the other, but the best laid battle plans don't survive the heat of battle. And which says to me, you know, don't get too down in the weeds doing your plans, because you're going to have to be making stuff up as you go. But you want to have a general idea, so when you get there, you're not like, oh shoot, this is what the hell do we do now? You want to have something to be a direction to be going in. So and that to me seems like the good balance.
Yeah, that makes a lot of sense actually. So, well, awesome, Ed. I appreciate you taking the time to come and talk to me today about this, because I love getting your perspective on where we've been and where we are, and kind of how you're navigating it.
Well, thanks, John. It's really my pleasure. I love every opportunity I get to talk to you, and I love your podcast.
Thank you.
Listen to them regularly, and look forward to the next time we'll see each other in person, which I hope will be at one of your events soon. Yeah, no, that would be great. Yeah, definitely. So I appreciate it. Thanks. All right. Take care. Well, thanks. Yep. Bye-bye.